Hey there, John Hunter, your mortgage guy, coming back to you again this week with another rate update. This one for the week ending in February 9th, 2024. So this week, the fight continued between the bond market and the Federal Reserve. Bonds see inflation slumping and growth sagging, and the Fed is seeing a firm job growth and solid consumer confidence, which those two basically are conflicting with each other, and we're seeing this roller coaster, day to day. So the week ended higher than it did end last week. So we had 30-year fixed at about 6.5 to 7.25, 15-year fixed 6 to about 6.625, FHA 6.5 to 7.25, VA 6.375 to about 7.25, and down payment assistance coming in around 7.125 to 7.625. Now, guys, remember credit score, loan amount, loan type, property type, whether you're a first-time home buyer, whether you are below moderate to median income, all of those things play a role in the rate that you get and what the price adjustments are. So take that with a grain of salt. This is just for giving you an idea where rates are and what the trend is. So that's where we ended the week. So we've fallen into a clear pattern here the last couple of weeks, which is basically we have these numbers that are coming out about employment and some about prices. But remember, who's creating these numbers? These are government-sponsored economists coming up with these numbers. And you really have to take it with a grain of salt, because half of these reports, after a few days after the report comes out and the headline passes and the real deal gets dialed down on some of these numbers, can be pretty deceiving. So that's why you're seeing this fight back and forth. The bond market is thinking, hey guys, the Fed, you guys are done. You can start lowering here pretty soon. It's not going to hurt the economy. It's not going to heat up too much, because most of the time you wait for it to sag and then you're a day late, dollar short. So this is probably no different, but hey, the Fed is the Fed, and right now they're betting that they're not going to do anything till May now. So we're just going to have to see who wins that fight. Ultimately, the rates are a market-driven vehicle, and it's the bond market does play a role in driving that. So mortgage-backed securities and like the 10-year Treasury bond, they mirror each other. So when the bonds are hot, typically mortgage-backed securities are well. So that drives rates down. But the Fed can only control the overnight rate that the banks charge each other, which ultimately does control the cost of money. But it's not dollar for dollar. It's not direct. It is market-driven. So that's why we can see rates move so quickly one way or the other, not always on what the market or what the Fed does, but it's what they say. What they're anticipating, right? Nobody on the market wants to be caught last to the game, last to the party. So that's why we see these things move so quickly, and why we see this volatility when there isn't a clear path. So next week, all eyes are on the CPI. This is a big one, the biggest one we're probably going to get for next week or two. And CPI is on Tuesday, and that's Consumer Price Index. The estimate right now is 2.9%. So if that comes in higher, that's bad news for rates. If that comes in lower, that is very good news for rates. So now the Fed likes the PCE, which is the personal consumption expenditure, but the CPI is right up there and high on the list. So I think it's going to be a real market driver. So let's pray for a number below 2.9 and have rates drop a little bit and make this a little bit easier on everybody else. So hey, John Hunter, your mortgage guide. Like, subscribe, come back every week. We've got more content like this, at least once a week, another video, and then this here at the end of the week, the rate update. So John Hunter, your mortgage guide. Like, comment, subscribe, and I will talk to you soon. Bye-bye.